Oil prices fell after the International Energy Agency raised its forecast for the global oil surplus to a record high for 2026, expecting supply to exceed demand by almost 4 million barrels a day. Let's get more on this from Rory Johnston, founder of Commodity Context. Good to have you. Thanks for taking the time.
Thanks for having me.
Can you explain exactly what International Energy Agency is doing? Like, why did they raise that estimate there?
Yeah, so the International Energy Agency, the first thing I should say is this is a scenario that assumes OPEC Plus will keep production flat around current levels and everything else kind of continues to be dynamic. The surplus for next year, as OPEC continues to announce increases to its production levels, has continued to swell, report after report after report. So this latest October publication sees an estimate of about 4 million barrels a day of oversupply on average through next year. That's up from 3.3 million barrels a day in the last report. And just to put in context of how large a surplus this is, it would be the largest annual surplus on record. It would be almost twice as large as the surplus that we actually ended up realizing in COVID in 2020 during the peak of global lockdowns. This is not a trivial kind of surplus. And I should also note that given that it assumes that OPEC Plus is going to keep production flat, I should note that I don't honestly believe that the IEA itself thinks this is what's actually going to happen. I think it's more important as a parameterization, if you will, of how much supply needs to fall back in order to balance markets. And the answer is, by the IEA's numbers, roughly 4 million barrels a day, which is about 4 or 5% of global markets.
It sounds like you don't expect this forecast to be realized either.
That's correct. And I think that, just to be clear what we're talking about, 4 million barrel a day surplus on average is roughly 1.5 billion barrels of implied inventory builds next year. That's almost as much as the entirety of current U.S. oil inventory in the entire country, just added on another year. That's way too big. It would drive prices way too low. And I think that's generally what's going to happen. Prices are going to drive lower until they can drive non-OPEC supply out of the market. Given that the United States is the most price sensitive and fastest reacting type of supply on the supply stack globally, we expect it's going to be them. But even then, you didn't lose 4 million barrels a day of U.S. production during COVID because OPEC stepped in. What we need is prolonged, very, very low prices to get that kind of correction. And I think the question is, will OPEC itself and Saudi Arabia tolerate those types of prices? I think much more likely is that OPEC itself rationalizes this current easing back into the market, these production hikes that they've been engaged in, once the price begins to fall apart. We've seen that they, at this point, are clearly no longer that concerned about defending higher prices like we've seen over recent years, but we have yet to see what their lower kind of threshold of pain is because that hasn't been tested. It's very easy to say we're going to keep increasing production when prices are in the 60s or 70s. We need to see whether or not they're going to continue announcing these incremental monthly hikes in production with prices now for WTI in the 50s and heading lower.
So is that what needs to happen then? Like to watch and see what's happening in terms of supply and demand? Do we just need to stop looking so long term and just kind of be a little more short-sighted?
I think both are important. I think, there's this large question about whether or not the peak in oil demand is going to come at the end of the decade, or maybe you're in the early 2030s, or maybe never. But this is a very long-term debate. We're having a much more acute and pronounced shift in this market, a transition, if you will, happening this year and next year from a protracted kind of 2021 to 2024 period of persistent undersupply in the market to now likely seeing a persistent oversupply. And markets are going to need to reflect that. Demand has been growing far slower than it was in pre-COVID, on the pre-COVID norm. And given that, that's going to leave more and more of this balance to the supply side of the ledger to adjust and kind of moderate.
So demand and supply are obviously the main factor here. Are there other factors that are kind of impacting the price of oil, like what we're seeing, those tensions between the U.S. and China? Are there other geopolitical factors that are really coming into play here, or is it just supply and demand?
So I think supply and demand is how this works out in the medium to long term. But in the short term, there's obviously sentiment and various other factors that are driving this. I'll just mention two. So on the one side, one thing that's been keeping the market, and both of these things, I should say, are keeping the market stronger than I think it otherwise would be. On the one side, you have Chinese policymakers acutely aware of their own energy insecurity, building up dramatic gobs of the strategic inventory domestically in China. That is coming, at various points this year at the pace of almost 1 million barrels a day of increases in Chinese SPR, that's being registered by the market as demand. So I think that is keeping the market supported in the near term. It could fade, but it's still going strong, as of latest data. The other thing is that during the past couple of years, we've just seen repeated bouts of geopolitical risk and various other concerns about supply, particularly in the Middle East. That is keeping people very wary of going too short the front of the crude curve for fear that they could get blown up on the upside for the next, attack on Iran or the next sanctions announcement. So while the market is weakening, I think people are wary of getting too short at the front end because they might get kind of run over by a freight train on the other side.
Just before we wrap up here, is there a space in here for Canadian oil producers? Like, how is all of this affecting Canadian oil producers, or is there more room for Canada to produce oil, which is what some provinces are looking to do at the moment?
Yeah, so I think while you're absolutely going to see, a near-term slump that's going to make it harder for Western Canadian oil producers given lower prices, I think that even in a lower price environment and even at a slower pace of global demand growth, Canadian production can compete competitively as long as we can have access to those markets in order to compete on a fair kind of barrel-to-barrel basis. This means incremental pipeline capacity expansions, hopefully to the West Coast, but the latest chatter in the Carney-Trump dialogue is, a reincarnation of the now long dead Keystone XL pipeline. But I think at the end of the day, any pipeline will do. We're just going to need egress availability so that if producers do take the risk to increase production in this uncertain environment, they can realize the upside reward should prices kind of turn that way again.
Okay. Rory Johnston, founder of Commodity Context. Good to have you. Thanks so much.